Question 5 is based on the effects of IAS 8, accounting policies, changing in accounting estimates and errors, and in this case is particularly picking up on how we account for errors. So the main aspects of IAS 8 are that between change of policy, estimate and dealing with errors, whether we need to make retrospective adjustments or whether we simply reflect those changes from this point forwards. In the case of changing policy or correcting errors, everything is dealt with on a retrospective basis. What that really means is that we need to do two things. Firstly, we need to restate the comparative figures that appear in the accounts. And then secondly, we would need to restate the opening figures in our statement of changes in equity. And most commonly, this will be the retained earnings because of the effect that that error might have on profit. In this particular case, the error that's been identified is that revenue has been overstated by $100,000. What that really means is that profit has been overstated by that $100,000. But in taking account of the effect on profit, we would also need to think about what that does in terms of tax. And in this case, with a tax rate of 30%, if we were to reduce our revenue by $100,000, we would also reduce our tax charge by 30% of that figure. So in this case, we would end up with a reduction in tax of $30,000, so that the net effect on our profit is actually the difference between the $100,000 and the $30,000, which here would give us an adjustment to make of $70,000. So if we go and look at the answers that we've been given, we can see that two of these include an adjustment of $70,000. And then the next stage is to try and work out what the difference between those two possible answers is. What I can see is that the first says that as well as showing a net decrease in the comparatives, we would go and amend retained earnings brought forward, whereas the other option is that we wouldn't amend the retained earnings brought forward. The correct answer here is that, according with IAS 8, as well as restating our comparatives, we do need to restate our opening retained earnings, and so yes, the first option is the correct answer.